We denounce these illegal tariffs, and we think that they're a direct attack against our workers and now in the copper industry. And so we'll fight again.
Ford has acknowledged that these tariffs will carve a $2.5 billion deficit in its 2025 financials. Across the city, experts caution that Stellantis could face a 75% profit plunge if the duties persist. However, the real twist unfolds north of the border. Canada's Foreign Minister Mélanie Joly, now in a combative stance, has labeled Washington's levies a direct attack on Canadian laborers, marking July 21st as a critical deadline. Remove the tariffs, or Ottawa will retaliate with power restrictions, metal export limits, and a $29.8 billion Canadian dollar countermeasure. Once celebrated as partners in the world's most seamless supply chain, the two nations now resemble adversaries. One side hurls tax salvos from the White House, while the other quietly secures new buyers from London to Jakarta. Time is running out. If the U.S. president relents, Detroit might find relief. If not, Ottawa's next strike will hit, and workers on both sides of the border will bear the brunt. Washington invoked Section 232 of the 1962 Trade Expansion Act, a Cold War-era tool meant for securing missile components, to impose new duties on steel, aluminum, copper, and even Canadian vehicles. The stated goal: safeguard national security. The reality: Canada, a key ally, supplies half the metal that powers Detroit's production lines. This isn't an isolated move. In early July, the White House sent identical warnings to 20 global capitals, demanding new bilateral trade agreements or face blanket tariffs of 25% to 50% starting on Liberation Day. It's a worldwide ultimatum: comply or pay. Markets reacted swiftly. Foreign investors offloaded U.S. treasuries, driving up yields and pulling billions from New York in a single week as they sought safer markets. Diplomats took note as well. If a trusted ally like Canada can be deemed a threat, who's next? When the White House cites national security, allies now hear coercion. With July 21st looming on Ottawa's calendar, the question isn't whether Canada will back down, but whether Washington's go-to-defense has turned into a liability. The White House's July 11th letter, imposing a 35% tariff on all Canadian goods, struck Ottawa like an emergency siren. Within 2 days, Foreign Industry Minister Mélanie Joly convened mining executives, including Glencore, Teck Resources, and Rio Tinto on July 8th, to outline a dual strategy. Reverse course before July 21st, or Canada will block its own pathways. Plan A is straightforward. Washington cancels the duties, and talks resume. Plan B is ready to go. Ottawa will match the U.S. with a 25% steel tariff and escalate with export bans on hydropower, primary aluminum, and softwood lumber, each selected to inflict maximum impact. Ontario's hydropower fuels factories in Buffalo and Syracuse. Quebec's aluminum supports 1 in 3 pickups built in Michigan. West Coast lumber constructs half the new homes in the Pacific Northwest. Ontario's Premier Doug Ford reaffirmed on July 12th that the province is prepared to impose a 25% surcharge, about $7 Canadian per megawatt hour, on electricity exports to New York, Michigan, and Minnesota starting at midnight on July 22nd. Grid analysts estimate this could cost U.S. buyers $200,000 Canadian to $300,000 Canadian daily, enough to erase slim summer margins for numerous upstate factories. Consumers are already reacting. Border data from July 10th shows a 76% drop in cross-border passenger trips from Canada to the U.S. compared to last year. Travel agencies are redirecting vacationers to Spain and Croatia, while airlines have cut over 320,000 U.S.-Canada seats for August. Duty-free shops from Niagara Falls to Montana report sales down nearly 50%. Joly's office describes this as a problem-solving approach, but the message is clear. Canada endured tariffs on aluminum, steel, and now copper. With only 10 days left, the calendar outweighs the rhetoric. If Washington yields, the tariffs disappear. If not, a domino effect begins at Ontario's dams, spreads through Quebec's smelters, and ends with tourists trading Disney tickets for European destinations. Until recently, a piston cast in Quebec could cross the Ambassador Bridge, be milled in Detroit, return to Windsor for heat treatment, go back to Dearborn for final machining, and make one last trip to an Ontario engine plant, all before powering an F-150. Industry estimates suggest some parts cross the border 6 or more times before a vehicle is complete. That intricate dance stopped on July 11, 2025, when the White House announced a 35% tariff on all Canadian imports, effective August 1st. That same day, General Motors paused its Silao, Mexico pickup line and warned its Windsor plant of a potential 3-week shutdown at Carney assembly due to border tax complications. Stellantis felt the first blow in April, with 900 U.S. layoffs and a halt at Brampton assembly after the initial 25% tariff took effect. Managers now say the July increase could turn a slowdown into a full stop. Copper prices soared to $5.68 per pound after Washington proposed an additional 50% duty on the metal essential for EV motors and wiring. Suppliers responded by tacking surcharges onto every harness and radiator shipped this month. Ottawa's response targets the same vulnerabilities. On July 12th, Ontario confirmed it will impose a 25% hydropower export fee at 12:01 a.m. on July 22nd if the tariff deadline passes, raising power costs for over 170 plastics and stamping plants in upstate New York. Meanwhile, Sudbury mines are set to divert aluminum billets to Rotterdam, depriving U.S. smelters already grappling with a Midwest premium now triple its 2021 level at 60 cents per pound. For consumers, the numbers are grim. The Alliance for Automotive Innovation predicts vehicle prices could rise 25%, or about $7,000 on a mid-size SUV, once summer stock clears. Dealers in Ohio and Texas report buyers rushing purchases to avoid the August crunch, while banks note a surge in 7-year auto loans as families prepare for higher costs. The border itself is cooling. Canada Border Services data, shared with Reuters, shows an 18% drop in Ambassador Bridge truck traffic over the past 10 days, while Amtrak's Toronto-Chicago route cut 2 daily trips after southbound bookings plummeted. Automakers, long accustomed to tight margins and just-in-time logistics, now face a costly obstacle course. Every border crossing adds not just time, but thousands in taxes and metal premiums, compounding with each mile. The July 21st deadline looms, and each tick of the clock leaves another piston stranded at a customs booth and another buyer staring at a showroom price resembling a home loan. The stranded piston is only part of the issue. Step into a hardware store this week, and your wallet feels the rest. On June 9th, the Midwest aluminum premium hit 61.515 cents per pound, a 161% increase since January. Sheet metal buyers secured orders, but the surge continues to ripple. By July 14th, Chicago's hot rolled coil remained near $881 per ton, about a third higher than last fall. These costs infiltrate everything: car panels, refrigerators, even barbecue lids. The price hikes are no longer hypothetical. On July 12th, Coca-Cola bottlers informed investors they're shifting summer campaigns to plastic bottles after tariffs pushed aluminum can cost beyond budgets. A June 24th Reuters survey of packaged food companies revealed smaller brands experimenting with foil pouches and cartons to avoid metal costs. Builders face tougher choices. The National Association of Home Builders warned in May, and again on July 8th, that tariff-driven increases in steel, copper, and lumber will add roughly $10,900 to the cost of a new single-family home. Ohio mortgage brokers say this prices out 1 in 12 first-time buyers. Households feel the pinch at checkout, too. The S&P Global PMI report from July 11th noted the steepest rise in selling price inflation since last winter, with furniture and recreational goods hit hardest. The San Francisco Fed estimates that if August tariffs take full effect, real household income could drop 0.4%, or about $320 on the median paycheck before year-end. Ottawa's planned retaliation, including a 25% hydropower export fee set for July 22nd if negotiations fail, will raise factory power costs south of the Great Lakes, soon hitting grocery stores and auto parts shelves. Tariffs were pitched as protection, but the bill lands at checkouts and closing tables far from any border. Every cent added to aluminum, every dollar tacked on a steel, ends up in consumers' carts. The question isn't whether shoppers will notice. It's how long they'll keep paying before a true slowdown hits. Trust is now the rarest resource. Since President Trump's tariff campaign began, Canada's dependence on the U.S. market has fallen from 78% to 68% of its exports, while trade with Europe, Australia, and Japan has grown 42% in value. Ottawa touts this shift as evidence it can thrive without U.S. reliance, with exporters quietly drafting contracts in euros or yuan to sidestep future tariff risks. This pivot signals a larger shift. IMF data from July 9th shows the U.S. dollar share of global reserves dropped to 57.8% by late 2024, the lowest in 30 years, while the euro rose to 20.1%. It's a subtle fracture, but it grows with each tariff threat. Investors are hedging, with 4 months of tariff warnings wiping out roughly $4 trillion in U.S. stock market value, driving funds to gold and European bonds. The San Francisco Fed warns that these duties could cut real household income by 0.4% over the next year, a pay reduction felt long before any jobs return. The dollar's dominance isn't collapsing, but the erosion is underway. Each tariff announcement pushes another load of Canadian aluminum toward Rotterdam and another banker to price shipments in euros. Confidence, once a given in trade, is now the hardest commodity to secure. What if every trip to the store felt like a tax increase? In 6 weeks, Washington's 35% tariff disrupted the Canada-US supply chain, halted auto plants, and drove aluminum costs 162% above January levels. TSX futures fell 0.1% on July 14th as investors grappled with new tariff threats and stalled talks. The San Francisco Fed cautions that if tariffs persist, U.S. real household income could drop 0.4%, or about $320 per median paycheck before the year ends. Will the White House back down before July 21st, restoring the neighborly trade rhythm? Or will Canada forge ahead, building new partnerships in euros and yuan? Share your thoughts below.